Sometimes the quietest market headlines, they actually hide the most dramatic stories happening just underneath. You might see a report, S&P 500 slightly down, NASDAQ barely up, and think, okay, pretty quiet week.
Well, at Surface Calm, it rarely tells the full story. Welcome to the Deep Dive. Today we're cracking open the Loop Market Weekly Tech and Healthcare Dominance Report. This is for the week of September 1st to 7th, 2025. And this report, it really offers an incredible lens into those, let's say, hidden market movements. Gives us the real narrative. So our mission today, go beyond those headlines. We want to reveal the significant sector shifts, the individual stock moves that really drove things, even those subtle index changes. We're here to give you, our listener, a truly revealing perspective on what happened last week. We're going to dive into which sectors led, which lagged. We'll look at specific companies like Hewlett-Packard Enterprise and Western Union. We'll try to understand the institutional money flows driving these things, and maybe even peek into what it means for the week ahead. So let's peel back the layers. Okay, first, setting the scene.
On the surface, like we said, the overall market indexes look pretty tame for that week, September 1st to 7th. S&P 500 down just 0.1%. NASDAQ, a small gain, 0.2%. Dow slipped a bit, down 0.3%. Pretty modest. But here's where it gets interesting. These tiny shifts, they masked what the report called significant underlying sector rotation. The report is quite emphatic. This rotation told the real story. So for our listener who mostly just sees those big index numbers flashing by, why does this idea of sector rotation matter so much more than those, tiny aggregate moves?
Yeah, that's a great point. Sector rotation is, well, it's precisely about where the conviction lies. It's when investor money, especially the big institutional funds, cyclically moves from one part of the economy to another. Often they're anticipating different stages of the economic cycle, or maybe just changing market conditions. And why it matters more than the overall index, because it shows you where the big money is actually going, where they're placing their capital. It signals where they believe future growth, or maybe safety, lies. It's not just general market noise.
Yeah.
So the big takeaway here is really don't just look at the headline number. It's those hidden shifts, the churn underneath, that often tell the true story.
Okay, so looking at where that big money was moving last week, two sectors clearly led the charge. Paints a very different picture. Technology, no surprise there maybe, continued its leadership, showed pretty remarkable resilience all week, but it wasn't alone.
Right. Tech was strong.
And the report also highlights healthcare emerging, calls it a crucial secondary leader, apparently attracting what it terms a defensive bid from investors. What exactly is a defensive bid, and why would investors be making one for healthcare right then, especially when the overall market seemed, well, relatively flat?
A defensive bid, it basically signifies increased demand for stocks and sectors seen as stable, less susceptible to economic downturns. Think essential goods and services. Healthcare fits that bill perfectly. So it's investors looking for a safe harbor, maybe, or just a stable base when there's even a whiff of uncertainty out there.
Okay, seeking safety.
Exactly. And if you connect this to the bigger picture, this leadership in both tech and healthcare, it's directly confirmed by what the report saw in institutional money flows, steady inflows into both sectors. So institutions are flocking to tech, presumably for growth and innovation, right? But the simultaneous move into healthcare for stability, that suggests a kind of nuanced view. Maybe a bit risk-off, stability on dynamic playing out. It's like the big players are hedging their bets. That's a powerful signal.
Hedging their bets. Interesting. Okay, so now, the flip side. In sharp contrast to those leaders, we saw consistent underperformance from financials and energy. The report used some pretty strong language, actually, noting these sectors were bleeding and closed the week as confirmed lags. What does it mean for a sector to be a confirmed lag in market terms? And what does this bleeding really tell us about how investors were feeling?
Right. Confirmed lag isn't just, a bad day or even one bad week. It points to a sustained period of poor performance relative to the market and negative investor sentiment building up. It signals that it's consistently trailing the pack.
So persistent weakness.
Persistent weakness, exactly. And the term bleeding suggests continuous outflows of capital, money leaving the sector. What this tells you about sentiment is pretty clear. A lack of confidence, a persistent lack of confidence. Investors are actively pulling money out, suggesting they either expect more headwinds for those sectors or they've just found much better places to put their capital. It's a strong signal of bearish sentiment, specifically for financials and energy last week.
Okay, bearish sentiment there. Let's zoom in a bit then. From these big sector currents to some individual companies, because this is where these stories really come alive, right? The report spotlights several key tickers. Top of the list for outperformance, Hewlett-Packard Enterprise, ticker HPE.
Yes, HPE.
It was the absolute top dog for the week, apparently. Achieved an impressive 4-day beat streak. Also confirmed a breakout into the profit zone, and the report's market engine flagged HPE as breakout active with momentum intact. This market engine sounds interesting. Can you give us a little glimpse? What kind of system is it, and what do these specific flags mean? Beat streak, profit zone.
Sure. The market engine is essentially an algorithmic system. It's designed to continuously analyze just vast amounts of market data. Think price action, trading volume, institutional flows, sector strength, all of it. Its goal is to identify early shifts, significant movements, both in individual stocks and broader sectors.
Okay, so it's crunching a lot of data.
A lot of data. For HPE specifically, a beat streak means it performed positively or beat expectations for 4 straight days. That's quite significant momentum. Breakout active means it pushed past a key resistance level on its price chart, which often suggests potential for more upside. The profit zone is a classification within their system, basically meaning the stock's in a favorable position, maybe after significant gains. And momentum intact is pretty straightforward. It tells us the upward trend was continuing strong without signs of stalling yet.
Got it.
And its strong outlook, as the report mentions, suggests this is likely to continue if those broader technology sector flows persist. It really highlights the why behind its big move. It's riding that strong sector tide.
Makes sense. But while HPE was soaring, not every stock had such a clear run, did it? Let's talk about Hershey Cups, HSY. More of a mixed week for them. It initially benefited from what the report called a defensive staples bid.
Okay.
Another term there. For those less familiar, what does defensive staples bid mean?
Right. A defensive staples bid refers to an increase in demand for stocks in the consumer staples sector. These are companies making essential goods, things people buy pretty much regardless of the economy, food, beverages, household products. Hershey fits right in there. Investors often shift into these kind of stable areas when they're feeling cautious about the market overall, seeking predictability, maybe over high growth.
Predictability. Okay. So HSY saw that initial boost, people looking for stability, but then its momentum faded, ended its beat streak, and its status reset to just match. What does that match status tell us, and what does it imply for Hershey going forward?
Match is essentially a neutral status in this system, not really outperforming, not underperforming significantly either. It indicates HSY basically settled back into equilibrium after that initial defensive surge. The enthusiasm waned. Its future trajectory, as the report points out, is now pretty closely tied to the broader staples rotation, which implies its performance will likely depend more on how that whole sector moves rather than something unique to Hershey itself. It's not leading the charge anymore, just moving with the crowd.
Okay, so its fate is tied to the sector now. And then the other end of the spectrum, Western Union Company, WU, identified as the weakest performer, experienced a 4-day lag streak, moved deeper into caution zone, and the market engine flagged it, extending lag streak heavy caution zone. That sounds pretty serious. What's a lag streak, and what does being in this caution zone imply for a stock like WU?
Yeah, heavy caution zone definitely gets your attention. A lag streak is simply the opposite of a beat streak. It's a continuous period where the stock performs poorly or below expectations. 4 days of that is a definite red flag. The caution zone classification signals substantial risk or ongoing underperformance. Needs careful watching.
And its outlook.
Well, Western Union's lag status is expected to continue unless, and this is key, unless it can reclaim its short-term moving averages with significant volume. Let's break that down. Short-term moving averages are technical analysis lines that smooth out recent price action to show the near-term trend. Reclaiming them, meaning breaking back above them, especially with significant volume, lots of trading activity, would be a concrete sign. A sign of renewed buying interest and potential strength. It gives you a clear, actionable condition to watch for any potential turnaround.
A specific benchmark. Good to know. The report also mentioned a bunch of other tickers: MRNY, PSKY, CHCT, KSBY, USPH, CCIF, IQI, GPK, basically saying they were neutral, flat, or inactive. It's a good reminder, I guess, that while these big currents moved some things dramatically, a lot of other stocks just stayed put, waiting for their own story.
Absolutely. Not everything is in motion all the time. That neutrality can itself be a signal, perhaps a market holding its breath in certain areas.
So let's tie this together. Why all these specific movements? Strong leaders, clear laggards, even though the overall market looked flat?
Yeah.
The report really hammers home the role of institutional money flows, says that's the fundamental driver.
Mm-hmm.
And the data seem to strongly back up the sector performance, right? Steady inflows for tech and healthcare,
Mm-hmm.
fading interest for staples and financials and energy still bleeding out, as they put it. So it's not just price moves, it's where the serious big money was actually being put to work or pulled from.
Precisely. That flow data provides crucial confirmation.
But here's something that struck me as, well, intriguing. Despite these very clear winners and losers sector-wise, the report said overall market breadth remained mixed. Market breadth. That's basically looking at how many stocks are going up versus down, right? To gauge the overall health.
That's correct. It's a technical indicator looking at the number of advancing stocks versus declining stocks.
So why would breadth stay mixed when we saw such dramatic shifts underneath? What does that tell us about how these dynamics can sometimes be hidden by the averages?
Yeah, that's a really key insight into how these things can hide within the aggregate data. Market breadth stayed mixed because, as the report explains it, those opposing institutional money flows were so strong they effectively balanced each other out, on average. You had strong money going into tech and healthcare, and significant money coming out of financials and energy. It's almost like, imagine a tug of war where both sides are pulling incredibly hard, but the center flag barely moves. The tension is immense, but the overall position looks stable. Those underlying flows, that tension, that's the real story, even if the broad market index or the breadth calculation looks kind of neutral. It shows who's gaining ground and who's losing it internally.
That's a great analogy, the tug of war. Okay, so with all that context, what does this report suggest we should keep our eyes on for the week ahead? It seems to give some pretty actionable insights based on these movements for HPE.
For HPE, the outlook is pretty clear, according to the report. If those technology sector flows continue, expect strong continuation. Its momentum is described as very much intact.
Okay, watch the tech flows for HPE and HSY, Hershey.
HSY's path really hinges on that broader staples rotation. Its individual story seems less important right now than the overall sector trend. So you'd need to watch how the whole consumer staples group performs to get a sense of Hershey's likely direction.
Got it. Tied to the sector. And then Western Union, WU.
WU is expected to stay in that lag status under pressure unless it meets that very specific condition we talked about, reclaiming its short-term moving averages with significant volume. That's the concrete hurdle it needs to clear to signal a potential turnaround.
Specific conditions to watch. That's helpful. Moving beyond just observing to maybe anticipating.
And that, for you, is our deep dive into the Loop Market Report for the first week of September. It's really a powerful reminder, isn't it? The most compelling market stories, they often aren't in those big headline numbers. They're in those powerful currents. Sector rotation, institutional money flows bubbling just beneath the surface. This week showed how a seemingly quiet period actually had some pretty dramatic shifts playing out underneath. Understanding these dynamics, how sectors lead, how they lag, how individual stocks respond, it gives you a much richer perspective, a more informed view on market movements. It helps you see beyond the surface, to be, let's say, truly well-informed, not just broadly aware of the daily headlines. So here's something to think about. In a week where the overall market seemed pretty flat, we saw that clear defensive bid in healthcare, a search for safety, right? Well, financials and energy were bleeding. What does that divergence tell you about the underlying anxieties, maybe? Or the anticipations of those big institutional players, even when the market surface looks calm? What might it imply about challenges or opportunities lurking beneath that apparent stability? It really forces you to look at those hidden currents, not just the surface tides. And that's often where the real insights are found.